Ted Rossman joins me now. He's a senior industry analyst with Bankrate.com and creditcards.com. Ted, what do you make of today's decision? As Owen mentioned, certainly expected. Does it go far enough to tame record inflation?
I think it's a step in the right direction, but we're definitely going to be seeing more of this in the months to come. In fact, Chair Powell, during the press conference just a few moments ago, indicated that another 0.75 percentage point hike could very well be on the table for next month. The median projection for Fed officials takes the federal funds rate to nearly 3.5% by the end of the year. So we could be talking another couple of percentage points. It's that cumulative effect that I think really could help to combat inflation, but also poses a risk for anybody with variable rate debt. If you have, let's say, credit card debt or a home equity line of credit or a private student loan, these are the kind of debts that are really going to be feeling the interest rate increases.
Ted, for ordinary consumers, which is worse, recession or inflation?
That's a really good question. I mean, I think that right now, this is tough medicine. The fact that, everybody hates inflation. We don't like paying so much more for gas and groceries and rent and other things. But this is the difficult medicine. And I do think that this actually may exacerbate this K-shaped recovery that we keep talking about, where the rich get richer, the poor get poorer. I mean, right now, the biggest strength we have in the economy is the job market. And I think that's what's really helping to keep consumer spending strong. It's keeping delinquencies and defaults very low. It's one of these all news is local kind of things. I mean, if you have a lot of debt, especially variable rate debt, or if your job is more at risk, then you're more at risk versus somebody who may be more comfortably upper or upper middle class that may be able to weather this a bit better.
So it's certainly making the cost of borrowing more expensive, today's decision by the central bank. What are some of the other immediate impacts for consumers who may not have a lot of credit card debt?
The most immediate impacts are those variable rate debts that will be going up very soon, like credit cards and home equity lines of credit. Aside from that, somebody who may be in the market for a new loan, that's where, like in the housing market, for instance, this is having a huge effect because mortgage rates are set more in line with 10-year treasuries. So they actually tend to move more in advance of the Fed because they're anticipating these moves and investors are pricing in those anticipated moves. So we've actually seen the average 30-year fixed rate mortgage go from 3.25% at the end of last year to very close to 6% nowadays. It's the fastest 2 percentage point increase that we've ever seen. And now we've actually blown past that. I mean, we've seen mortgage rates go up almost 0.5 point this week. So that's having a big chilling effect on home sales. You think about buyers looking to enter the market, this is akin to a 25% drop in home affordability. And then even for somebody who owns their home now, there's less incentive to trade up because whatever you're buying is going to have a higher price tag and a higher interest rate.
Okay, so here's a question we're all talking about. Gas prices, groceries. It used to cost me about $45 to fill up my gas tank. It now costs me almost $70. You buy just a few items at the grocery store. Prices have gone through the roof. So will today's rate hike, are we going to see any change in the prices that we're paying?
It's a step in the right direction, but it's going to take some time. There's always a lag with this sort of monetary policy. The other thing that I think is really relevant is that this doesn't mean that prices will eventually go into reverse and go back down. I think really the Fed's goal here is to slow inflation. Deflation is actually, I mean, it's very far from what we're experiencing now, but that's actually a bad thing for economists too. But I think the point is that we're going to have to get used to these higher prices. That even if inflation slows from here, we're now building off a higher base. And to your earlier question about what's worse, higher rates or inflation, I mean, I think that inflation is something that everybody is feeling, and we really need to get this back down to a more reasonable level because we're feeling it in all aspects of our lives. And I think that's the cumulative effect that's really significant.
All right. I was hoping you to give us some good news saying this will all come to an end very soon, but you did not do that. Ted Rossman, thank you very much.